Hey everyone, today we are going to talk about something that has sent shockwaves throughout the tech industry. I'm talking about the sudden collapse of Silicon Valley Bank, one of the biggest players in the game. So, what happened? How could a company that was seemingly doing so well just overnight fall apart? Well, the truth is, there were a number of factors that led to this catastrophic event. For starters, the bank had been heavily invested in a number of risky ventures, particularly in the tech sector. While these investments had paid off handsomely in the past, they were beginning to look increasingly shaky as the tech industry faced a number of headwinds. But before we delve deeper into this problem, let us first know the SVB. Well, simply put, it's a bank that's focused on serving the needs of the tech industry. Founded in 1983, the bank has grown to become one of the biggest players in the game, with a reputation for being the key partner for startups and tech giants alike. But what makes Silicon Valley Bank so special? Well, for starters, it has a deep understanding of the tech industry and the unique financial needs of tech companies. Whether it's navigating the complex world of venture capital or managing cash flow in the face of unpredictable revenue streams, Silicon Valley Bank has the expertise and resources to help companies succeed. From loans and lines of credit to international banking and investment services, Silicon Valley Bank provides a wide range of financial tools that are tailored specifically to the needs of tech companies. This can be incredibly valuable for startups and other tech companies that might be struggling to find the right financial partner. For example, the bank offers a range of lending products, including lines of credit, term loans, and equipment financing. Additionally, the bank offers a number of cash management and treasury services, which can help companies manage their finances more efficiently. But the benefits of Silicon Valley Bank go beyond just financial services. The bank also provides a wealth of resources and advice to its clients, helping them navigate the often choppy waters of the tech industry. Whether it's through workshops, webinars, or one-on-one consultations, Silicon Valley Bank is always there to help its clients succeed. And that's really the key to the bank's success: its commitment to its clients. Silicon Valley Bank isn't just a bank. It's a partner that works closely with its clients to help them achieve their goals. Well, if you're a tech company or startup, Silicon Valley Bank is definitely worth considering. Its deep industry expertise, tailored financial services, and commitment to its clients make it a valuable partner for anyone looking to succeed in the tech industry. So now, we will reveal the thing that you are waiting for that leads to their sudden collapse. What exactly happened? Well, the truth is that investing in Silicon Valley Bank was always a risky proposition. Silicon Valley Bank was one of the biggest players in the tech industry, known for providing funding to some of the most innovative and promising startups out there. But despite its reputation, the bank recently collapsed, leaving investors wondering what went wrong. While the bank had a long history of success and had made some savvy investments in the past, it was heavily invested in the tech sector, which is known for its volatility and unpredictability. As you may know, interest rates have been on the rise in recent years, which has had a significant impact on the banking industry. Banks rely on the difference between the interest rates they charge on loans and the interest rates they pay on deposits to make money. When interest rates are high, this difference is larger and banks make more money. However, rising interest rates also mean that the value of fixed income securities, such as bonds, decreases. This is because when interest rates go up, the yield on those securities becomes less attractive to investors. This can cause significant losses for banks that hold a large amount of fixed income securities. Now, about the asset/liability duration mismatch in SVB. In simple terms, this means that a bank's assets and liabilities have different maturities. For example, a bank may have a lot of long-term assets, such as loans with a 30-year maturity, but short-term liabilities, such as deposits that can be withdrawn at any time. This can create a problem if interest rates rise because the bank's cost of funds will increase, but the interest it earns on its assets may not increase as quickly. In the case of Silicon Valley Bank, The bank had a significant amount of fixed income securities in its portfolio, and rising interest rates caused the value of those securities to decrease. Additionally, the bank had a significant asset/liability duration mismatch, which made it more vulnerable to changes in interest rates. As a result of these factors, the bank was not able to generate enough revenue to cover its expenses, and it was unable to maintain adequate capital levels. This led to the bank's abrupt collapse. The collapse of Silicon Valley Bank was not just the result of rising interest rates and an asset/liability duration mismatch, but also risky investments and a lack of regulatory oversight. Silicon Valley Bank, once a favorite of tech startups, suffered a massive loss when it sold off a significant number of securities at a loss and announced plans to raise $2.25 billion through selling new shares to shore up its balance sheet. This news caused panic among prominent venture capital firms, triggering a run on the bank and leading to a 60% drop in SVB stock in a single day. Regulators were forced to intervene and shut the bank down. While the U.S. government's bailout ensured that all depositors would receive their money back and mitigated concerns of a contagion effect, the ramifications of the collapse are likely to be felt across the tech and financial industries. The collapse of SVB highlights the risks associated with investing in fast-paced industries like technology, where valuations can fluctuate wildly and uncertainty is the norm. It also underscores the importance of regulatory oversight to ensure that banks are operating in a safe and sound manner. Without proper oversight, banks may take on excessive risk in pursuit of short-term gains, putting both themselves and their customers in danger. In the aftermath of the SVB collapse, there will likely be calls for increased regulation and greater transparency in the financial industry. Investors, especially those in the tech sector, will need to reevaluate their investment strategies and take a more cautious approach to risk management. While it's too early to say exactly how the fallout from this event will play out, it's clear that the lessons learned from the collapse of Silicon Valley Bank will be felt for years to come. It's important for banks to be mindful of their asset/liability duration mismatches and to have a strategy in place to manage interest rate risk. Additionally, banks should be careful about taking on too much risk in fixed income securities, particularly when interest rates are rising. The collapse of Silicon Valley Bank serves as a cautionary tale for other banks and investors. It's a reminder of the importance of sound risk management practices and the need to be prepared for unexpected changes in the market. So, what do you think? Are you worried about the collapse of Silicon Valley Bank? Do you think this is just the beginning of a larger shakeup in the tech industry? It's certainly a big deal, and it's a reminder of the risks involved in investing in the tech sector. But it's also an opportunity for the industry to learn from its mistakes and come back stronger than ever. What do you think about this topic? Share your thoughts in the comments section below. Don't forget to like, share, and subscribe to this channel. I'll see you in the next video.